Ladies and gentlemen, Christopher Aaron here. Welcome back. I took last week off right before the Thanksgiving holiday. I'm glad you were here. It is November 28th, 2018. And I also want to welcome you to this broadcast. Why? Because we have entered goose season officially. Yes, that's right. It is now goose season. And goose season is a special time of the year. So welcome. What am I talking about? Goose season. Well, what we saw today in this speech by Fed Chairman Jerome Powell was a classic example of goosing the markets. Okay, this phrase goosing the markets means when someone comes out and says something with the intention of trying to elevate or speed up the markets in a certain kind of way. And this is exactly what we saw from Jerome Powell today. So the speech that Powell gave at the Economic Club in New York, where he talked about stocks rallying after the Fed signals fewer rate hikes ahead. Fewer rate hikes. So the specific quote that I want to bring to your attention is that rates are just below the neutral rate. This is what Jerome Powell said today in the speech. And this is what caused the markets to go soaring, the stock market especially, to soar today after the speech. So rates are just below the neutral rate, meaning he's hinting that perhaps rates will not be rising that much more in the future, since they're just below the neutral rate. Are rates just below the neutral rate? I don't know. Let's look at the history of Fed-controlled interest rates here in the modern era. We're talking about post-World War II, the broad generational rising cycle in rates from 1% up to what? Almost 19%. And then the generational decline that just ended in 2015. Okay, just ended, where rates came all the way down to zero. And here's what everyone is freaking out about. Here is, in perspective, the rise from 0 to 2.25%. This is what's gotten everyone's, everyone in a tizzy and, freaking out about that the economy can't withstand higher rates. And of course, just remember that these Fed-controlled interest rates are not controlled simply. It's not like a button that they press. It's not a lever that they just push up or down. We're talking about how do they control these interest rates? Well, they're controlled by short-term bonds. And how do they force the bonds lower? In other words, force the interest rates lower. How do they do that? They have to buy bonds. What do they buy bonds with? They buy it with freshly printed money. And so when they are lowering rates like this, it means they're creating all this excess money, which is inflationary. And then when they're increasing rates like this, theoretically, on some level, they are extinguishing some of that money, therefore lowering the money supply and increasing the borrowing costs on these short-term bonds. Okay, so just remember, when we're talking about rising rates and falling rates, we're talking about euphemisms for how much money are they printing. Of course, we're talking about only one mechanism that they do it by. There are many mechanisms that they print money by. This is one of the primary ones, though. So this is where we are right now. This is what's gotten the markets all worried at the present. And we just have to look back and really try to assess for ourselves here. Is what Powell said true? Are rates now near the neutral rate? When we look back at the past 65 years of history, and we look at how many years was the Fed-controlled interest rate above the present level, just look at how long this rate spent above the line where we are right now, and how many years, just brief little blips throughout most of history, of course, leading up to the financial crisis of 2008. So I would argue that this is not the neutral rate that we're at right now. This is still a historically low interest rate, and that rates probably have, as a net sum, probably have a lot higher to rise over the next generation than they do to fall. This is what I'm arguing. So furthermore, so the stock market was higher today in the short run, thinking that, okay, they're going to stop extinguishing some money and perhaps cut rates again and begin to print more money, which is good for stocks. But look at when recessions happen in the United States. For example, look at the crash of 2008 here, this shaded color. Okay, shaded areas indicate U.S. recessions. So shaded color here. When does the shaded color happen? How about here, after the NASDAQ bubble? When does the shaded color happen? When does the shaded color happen? It happens when the rates are falling. Rates are falling. Rates are falling. So the fact that the stock market was higher today on the idea that perhaps they're going to stop raising interest rates, and what happens after they stop? They typically then begin to cut. The fact that the stock market was higher today is a very short-term reaction, almost a knee-jerk reaction from stocks that this is a good sign that the Fed may begin to reverse its course. But when we look throughout history, we look at the times when the Fed actually does stop and then begins to cut. This tends to coincide with recessions in the U.S. and stock market crashes in the last two instances. So I'd argue this is not a good thing, other than over the very short run, what we saw today in the stock market. Nonetheless, this is goose season. We are here, so we're going to keep our goose friend up here for the remainder of this week's video, just so we remember this is goose season. And how did the markets respond? We see the markets getting properly goosed. Stock market higher. Gold was a little bit higher on the day, really nothing to write home about. Commodities were higher, and then they sold off again. Bonds were lower. The U.S. dollar was lower. Gold miners really getting pulled higher by stocks. They were so oversold that with the rising stock market, you can see they were pulled higher with the stock market. I do not believe this. I do not believe this move. I think over the short run, stocks are going to be moving lower. We looked at this extensively in the last members update, how stocks had retested a broken trend and are now expected to begin to fail to overcome that trend. I think that is still the predominant trend here over the short run, and we'll see what happens when some lower targets come in. But I do not believe this move at all. I think it's going to stall out over the next several days, perhaps the next week, and begin to move lower again. But this is what the markets did over the short run. And we have to then take a look at the long run. And the idea here is that when Fed officials, when any of these officials come out, I'm saying this is goose season, this is not a one-time event. When we begin to see this type of thing, I remember this distinctly going back to the last cycle, 2007, 2008, 2009. When we begin to see this kind of thing, this tends to represent the shift in the behavior of a markets where officials, policymakers, believe that they now need to come out and begin to start saying things like this on a more regular basis. Okay, so anytime the stock market is weak, especially if you're going to be short stocks, you have to be very careful when these Fed meetings come around, because they like to come out and say things to try to goose these markets higher over the short run, but they cannot alter the long-term trends. That's the point here. So a way that we can look at this is through the ratio of the S&P 500. We're talking the broad U.S. stock market to gold. We're talking about a ratio now. And I haven't actually ever brought up this chart before in this kind of form. This is something new that we're going to be following. We will follow it occasionally here. We're going to follow it on a regular basis in the premium service. We are looking, once again, at the ratio of these two asset classes. We're talking about how many ounces of gold can you buy with one share in the S&P 500 index, the stock market? How many ounces of gold can you buy? So when you look at, for example, in the NASDAQ bubble in the year 2000, 99, 2000, you could buy, this was the record. This is the all-time previous record, okay? 5.6 ounces of gold you could buy in exchange for one share in the S&P 500. And then what happened after this bubble, let's bring up the color key here. What happened after this bubble is that stocks lost 89% of their value relative to gold into 2009, into the crash. Okay, so stocks, when we see values like this, stocks can lose a heck of a lot of value relative to gold. This is what happened in the previous cycle, a major revaluation in favor of gold. Now, since 2011, since the peak, what we can see here is that stocks have been in a rising trend. You can see that by blue, primary trend. Stocks have been in a rising trend relative to gold. However, we have approached a strong resistance level here. You can see that in black. Strong resistance at this 2.4 level. Why is this strong resistance? Well, first of all, we can see that the market bounced quickly lower from this level. This was just a month and a half ago. Okay, so the little mini panic in stocks coincided exactly with hitting this level. And look at how this level, when we go back in history, we look at how, for example, this level could not be exceeded here back in 2006, 2007, and how this level really acted as support here for a number of years. This one minor little blip below it, but a number of hits at this level and this consolidation here at this 2.4 level all throughout 2002, 2003, all the way through 2006. So when we see this kind of back and forth action here, and then a failure to overcome this level once again a decade and a half later, we are talking about strong resistance. In other words, people use this level to sell stocks and buy gold again. Remember, when the ratio is falling, it means that gold is gaining value relative to stocks. We've been in this counter trend rally. It's made a 38.2% Fibonacci retracement of the entire down move. And the question is, in this green window, we can see that this rising trend is meeting with the strong resistance right here at 2.4. What do they say? When two trends meet like this, one of the trends has to break. It has to break. You cannot have a rising trend meeting with strong resistance and both of them remain. They come to an apex. That apex is shown here in 2020, but in the majority of cases, these patterns resolve well before the apex point. That should be in 2019 coming up. We are within that window, plus or minus 6 to 12 months, where we will have a very solid answer. What is the answer going to be? If this trend breaks lower, we have a very strong reason to believe that gold is going to shine again, that this was a counter trend rally in stocks relative to gold, and gold is going to begin to outperform strongly again well into the next decade. If this ratio breaks higher over the strong resistance, unfortunately, it will mean that gold is going to continue to underperform, probably for many years into the 2020s as this ratio continues to move higher. Okay, so one of the things, so what am I saying right now? Can anything happen? Yes, anything can happen within the window of this green shaded area here. There is a very defined window where this ratio is either going to break this trend, you can see very clearly this trend, or it's going to break the strong resistance. So when one of these things happen, we will have a very clear signal as to what to expect from the precious metals well into the 2020s. If you're not following this ratio in 2019 specifically, you will not know what the expectation is for these markets. The Fed is obviously on the side of the stock market. We know that. Look at what they did today. Look at the reaction that we saw in stocks from the discussion of pausing in the interest rate cycle. But the point is here, if the Fed was all powerful, they would have been able to prevent something like this, okay? An 89% loss in the value of stocks. They are not all powerful, and the way that we will know if they have lost control is if this lower trend line here breaks in 2019. Right now, the number to watch for would be around 1.9 on the index, but this level is rising. So for example, in 2019, we could see this level breaking here at 2.1. Okay, and the close today, 2.24. It's not that far away where we will have a very clear signal. Is this goosing behavior working? Did the Fed succeed, or is gold about to re-exert itself once again? I can't predict everything. If I ever tried to come across as someone who can predict everything, well, that was not my intention. What I can do is I can read the charts and I can align with the probabilities. And I would just say to you, if you are heavily invested in the precious metals or you're thinking about that, please follow this ratio in 2019 because it is going to dictate much of your success. Same goes for silver, of course. Just silver performing like gold with even more leverage. So I do want to tell you, make sure to hit the subscribe button. If you like these kind of videos, the subscribe button is that red button below. You will get alerts when everything is available. I do want to thank those people specifically who are supporting these free videos on Patreon. It means a lot to me. Sincerely, thank you. If you would like to go deeper into the premium service, this kind of research, these kinds of updates. By the way, the update that came out 3 days ago, just 3 days ago, was like this video, covering about 10 more topics than were released in this video. That video is still current. It's up there. It was over an hour in length, a lot of information. So many things in that video that I think are so critical to these markets. So I just want you to know that is what you get if you choose to go deeper, if you want to go deeper into the premium service, all those things. And what we'll be watching into 2019, as I said, it's that answer to the stocks to gold ratio. It's the answer to that, and we will have that in real time. So just saying, if this is, if you're heavily invested in this sector, and you don't want to follow all this technical analysis on your own. You don't want to spend the hours and hours every day, every week, charting all these things, following this, aligning with the probabilities. This is why I do this. I do this so you can live your life and receive the most relevant technical analysis of what is impacting the precious metals from the standpoint of someone who doesn't sell the metals. So if we see that ratio breaking against gold in 2019, I have no problems telling that to people. Whereas we all know there are some individuals out there in the sector that would have a problem telling you that. Okay? I'm going to leave it at that. Thank you very much for watching. Be careful in this goose season. Things are about to get pretty crazy, I think, especially if stocks continue to fall, which I expect they are going to. Watch for this over the next 1 to 2 months, and we'll see what other kind of attempts the Fed makes to try to keep the markets elevated despite the fundamentals. Let's see. It's going to be an interesting time.